Good morning, it's Jeffrey Cohen. It's September 2nd, Friday. Market's opening. I'm wearing a green shirt because the markets look like they're going up. So I'm Jeffrey Cohen. I'm an investment advisor representative with U.S. Advanced Computing Infrastructures Incorporated, a non-discretionary investment advisory firm. We're in Illinois, and I'm an investment advisor representative. So what we do is we run quantitative models, and we sell the output to clients, typically investment managers, portfolio managers, or high net worth individuals. And so we are experimenting, we are paper trading our own model. And I want to share a little bit, first on what the market's doing, and second on, wow, it's really hard to run a model, and it probably needs to be a full-time job, at least in the morning, from like 6 in the morning till 10. Central time. And so talk about some of the challenges and some of the things we're learning. And let's go ahead. First thing I want to point out is some of your downtrodden stocks are actually doing well this morning. Of course, not Verizon at 41.65, and not Corbis at 1996. But let's take a look at, we were just running through a thing here. So let's show you some good stuff. We'll start with money managers, right? And we'll start to run through. We've got a view here that shows pre-market. And you see, and these are all market cap weighted. So I'll start with the big caps. Market cap weighted on the money managers, very bullish, very positive. Regional banks, very positive, very bullish. Retail, positive and bullish. Lululemon up 10% pre-market. Coal's up pre-market. Crypto and miners, both up pre-market, with the exception of Nucor, so maybe a firm-specific steel industry issue. Cannabis, tobacco. Tobacco's down. Cannabis is up. At least the larger the cap, the more cannabis is up. And so it's a healthy recovery there for cannabis. Chips and semiconductors, right? How we doing there? Pretty much all green with one very, very small red exception. And so markets look good this morning. Markets look like they're going to pop pre-market. Now what's interesting is diesel must be going up because 3 trucking companies are down pre-market, although generally logistics, transport, railroads are up. Computers, real B2B stuff here. Verizon, T-Mobile. So your comms are up and your makers of hardware are up. Hardware and software, yeah, they're up. So B2B looking good. And when we look just across the top ticker here, S&P futures are up, Dow futures are up, NASDAQ, Russell, gold is up, silver's up a little. It's interesting, though, that the bond yields are up. So we're going to look at that. We're going to take a quick look at bond yields. Bitcoin is up slightly. Let's take a look at bond yields, and let's take a look at, let's start with bond yields. Not bond yields, bond yields. I just had a conversation about fixed income this morning with a neighbor who's a sales rep for a fixed income desk. And he said rates are still going up. Interest rates are going up. So don't think for a minute that equities aren't going to feel some type of pressure from that. So we look at mortgage-backed securities. We look at, oh my God. All right. Zoom in there. Oh, no, not that much. What do I see? I see 30-year fixed rate conforming mortgages, 6.23%. So that gets a a pounded out message there, right? So you've got 30-year conforming fixed rate mortgages at 6.23% per Mortgage News Daily. I'll throw the link in there. And mortgage-backed securities, mixed. Interest rates quite high. Oh my God, that is really going to mess with housing prices. So we take a look at one-year treasuries. One-year treasuries are yielding 3.5%. Wow. That's really high. 10-year treasuries at 3.25%. Obviously, it's not as high as the 30-year, but it's still pretty darn high. I mean, yeah, it's not as high as the 30-year. It's not as high as the 1 year. But wow, it's pretty darn high. And the 30-year treasury at 3.37% is also pretty high. So what does this say to me? This says as rates rise, corporate fixed income will fall, and increased risk in corporate fixed income, especially investment grade, will rise too. So there's a stock that we like, just as an example. And some friends of mine own a lot of it, so I'm not going to talk about the name. But the debt to equity ratio, it's about 9-to-1. And they're paying down their debt. They're doing their best. You know, I love it. They even sold a piece of their business to pay down some debt. And it's great. But their last bond, unsecured senior debenture, is yielding 8%. Their interest costs have gone from, I don't know, $25 million a quarter to $40 million a quarter. So here's the problem. The problem is that rates go up if they're not able to just squeeze the lemon and pay down debt, and they have to go out to the market and issue more debt. It could happen. They could have a great opportunity to buy something, right? And so now they got to go to the debt market. What does that mean? They borrowed at 8% when U.S. Treasuries were 2%. They're going to borrow at 10% when Treasuries are at 4%. Or they're going to borrow at 12% because the risk premium goes up. Because can they really afford now $60 million in interest payments, or $50 million a year or a quarter in interest payments? Maybe not. And so that's the point. The point is that heavily indebted companies feel this twice. They feel the rate go up because of treasuries, and they feel the rate go up because of riskiness. And so this is going to hurt fixed income investments that are at new lows. So let's take a look at fixed income investments hitting new lows. How we doing there? Well, the first thing I'll tell you is type the words FINRA. I type FINRA and it shows up, but FINRA Morningstar. And you can go right to market data, and you see right here. So main page, right? Market data, FINRA, market data, and you look at the FINRA Trace. Trace is a database, by the way, where all fixed income trades get reported. They may not get reported immediately, but it's pretty quick. It's a universal database. By the way, we are regulated by FINRA and by the Securities and Exchange Commission. So I love these people. They do a great job. So let's take a look. New highs, 26. Investment, so it's not even investment grade. Let's go with investment grade. New highs in the investment grade fixed income market. 11 issues. Okay, not bad. Hey, Jeff, man, 11 issues went up. New highs. Okay, how many new lows? 1,594 new lows. I want that to sink in for a minute. There's 11 new highs and there's 1,600 new lows. That's like 150 to 1 new low to new high ratio. I don't care what planet you come from or what universe you live in. This is really bad for fixed income. And so we are in a fixed income terrible period. And look at that. The advancer decliner is like 4 to 1. So you have declines are about like 4.2 for every one advancer. So 150 to 1 new low to new high ratio is crazy. It's just all crazy. Oh, you're actually at like 1.2 to 6. Yeah, you're at like the decliners for investment grade is like 5 to 1. So bonds are speaking. They're speaking very loudly. If your stock investments have a lot of debt, this is something you have to pay very careful attention to. And so let's say you are looking at a stock that you own. So we own Verizon. By the way, we are not recommending that you buy Verizon because Verizon has been going down a lot and it is not for everyone. So heads up, Verizon, we own it. It is not for everyone. It is becoming a very risky stock right now, and that is not what it always was. So we're going to take a look at Verizon trades. And so if you look at this morning, so bond market trades early, right? This is today at 9:17. You've got 2034 debt yielding almost 5.1. You got 2051 debt yielding like 5.1. 2026 debt, which is just around the corner, yielding 4.2. 2027 yielding 4.3. 5.2 for 2042. 5.2 and a half for 20. So basically, Verizon is yielding between 4 and 5.5%, 4 and 5.3% for its fixed income. Now, it's a phone company, okay? It's a phone company that if you were to take a look at their coverage ratios, you type in SEC Edgar search, you go to the sec.gov company search page, you type in Verizon. By the way, I'm showing this to you. I mean, most of you guys know how to do this, but for those maybe who are just tuning in, maybe you don't know. And you see the 10K, 10Q. Good news is they publish a quarterly every quarter. You see how they're doing, right? You got a lot of debt. Oh boy, a lot of issues. But let's just take a look. How much cash do they produce? This is the last quarterly. It shows 3 months ending and it shows 6 months ending. So we'll take a look at the last 3 months and the last 6 months. There's this thing called cash flow from operating activities. I strongly recommend that you get comfortable with looking at a cash flow statement, because otherwise, how do you know how your company's doing? Personally, I get very frustrated. I want to know, do they got cash or not? I love cash. Do I have a wallet here? Let's open it up. I got a lot of cash. I want to see if Verizon is producing enough cash to pay for their debt, because otherwise, they're going to have to borrow more. I don't want them to borrow more. I want cash. Love cash. Okay? Let's see. Cash flow from operating activities for the 6 months ending June 2022 versus 2021. They produced $17.7 billion of cash in 6 months. Used to be 20 and a half. Okay? Now on investing, they spent 10 and a half on CapEx. They bought a couple of licenses and some other expenses. So they spent 15. So they produced 17 and a half. They spent 14 and a half. They got 3 left over. They spent that 3 on financing. They actually had to spend 5 and a half on dividends. And it's interesting. They seem to have gotten some cash from somewhere else and they use it to pay down some debt. So they paid down like $2 billion worth of debt in the 6-month period. That's not a lot. That's not very fast. And so, but that's interesting, right? Because it is interesting. They were able to pay back a little bit of debt. So then the question becomes, what's their interest cost? So we're going to take a look at the income statement now, and we're going to see how much did they spend on interest. That's interesting. It's tighter than I thought it was. I thought they were producing more cash than what they needed for CapEx for 5G. Might have learned something here, okay? So for the 3 months ending and for the 6 months ending. Oh, that's comprehensive income. That's different. I don't want that. Interest income. So they spent about $800 million for the quarter on interest. $800 million. It's pretty consistent. So that's not going to break them. They're producing $8 billion in cash flow from operations, so it's 10 times coverage of their interest expense. I don't think Verizon's going anywhere, but if that interest rate goes up, by the way, the good news is you don't have to pay more on old debt. Those have coupons, right? You clip the coupon, there's a certain amount you pay. This is future payment streams. This is on new debt coming out. And so they're paying down debt, so I'm not expecting that interest expense to go up. If anything, I would expect as rates go up, prices of bonds go down, and they can use maybe that $2 billion on repayments and maybe buy some market. Buy the market. Buy some 2027 to 2057 debt. Pick it up at 80 cents on the dollar. You're creating shareholder value there. You don't want to do a lot of it, but you do some because you want to have orderly markets, right? But, and you've got cash. Start building some cash on your balance sheet, right? And that way, when it comes time, 2026, I think it is, when they have some maturities, 2025, 2026, you can start to just pay them off. So, all right. So Verizon, not too scary. I just showed you how to look at the bonds, though, which is interesting. Mortgage-backed securities are, and this website is suggesting that mortgage rates at 6.23% are going to be really bad for housing. How are we doing overall? Let's just look at the real simple chart. How the future's looking. Equity futures are green. It's terrific. It gives me a real sense of relaxation. Crude oil's up, which isn't bad. It shows the economy's maybe picking up a little bit. Gasoline at $2.46 a gallon wholesale, still pretty good. Ethanol's down. So your bonds are going up. That's really going to help those who invest in bonds. Bonds are up. That's nice. That means yields are coming down, right? I don't know that I believe that because I just looked at another chart that said yields were going up. But it's not bad. Silver at 1782. Copper at 342. Mark my words. Copper is the economic bellwether. Right? So copper at 342 is down for a while now. But let's take a look. Pop that thing up. Copper at 342. I mean, it's been down to 319. It's been up to almost $5 just this past year, right? So you got room to move. I bet you if you were to look at this over time, yeah, $5, $2.50, $2, buck, 50 cents. So you go back far enough, there was plenty of copper for the amount of production that we do. During the crash of 2008, it fell from about $4 to about $1.50. So don't be surprised when it falls. When it falls from $5, $4.50 to $3.50, we already have evidence of a $4 to a $1.50 fall. And now it rose back up again, but when economic activity really compresses, something like copper, they're still going to make it. I mean, you have a mine. Of course, you're still going to make it. You still have contracts. So you're just going to build. It's an inelastic supply. So when demand goes down, the price changes. When demand goes up, the price changes. That's why I can hit $5. So copper's interesting. By the way to play copper, FCX. Now, we have not looked at their financials lately, right? Freeport-McMoRan. And so Freeport-McMoRan, my guess is that Freeport-McMoRan, yep, it's down with the price of copper. And my guess is if we were to look at monthly from 2008, we can't go back that far, but you would see that it's terrible. It probably was through the floor, right? And so this was a $5 stock during tough times. $5. They're not going anywhere. They're a really successful copper miner. So from $5, let's call it $10. From $10 to $50, you made good money. You ride it down to 30. You might ride this thing back down to 15. But I like Freeport-McMoRan. I think this is a long-term play, and so let's see how we do. So let's go back to the markets. Let's go back to regional banks. Let's see if anything changed. Oh, wait. I promised to share with you some information about our paper traded hedge funds. So what I'm going to do is I'm going to wrap up here so we can watch the market open, and then we're going to come back with a second video and we're going to walk you through some of those challenges. So I want to thank you very much for listening. This is terrific. I really appreciate you coming. And hit the subscribe button if you're not already a subscriber. We're not paid to make these videos. No one is advertising or telling us to make the videos. And we love you folks. We love the listeners. And we are going to continue working out the tweaks of this model and how to actually trade it as a fund. And at this point, we're not allowed to take investor money. We'd have to open things up. We'd have to increase our net worth on the books so that FINRA and the Illinois Department of Securities or Securities Department will allow us to take client funds. But for right now, we're just still discretionary. But we're building a model for how to run this fund. So thanks a lot. Good luck in the markets today. I mean, it's looking green. Green is good on a Friday. Best of luck. Don't invest more than you can afford to lose. If you have a gambling problem, call 1-800. I am not going to gamble anymore. And get the help that you need. Take care now. Bye-bye.